Hello everybody. I am sorry about the issues surrounding the Adobe Connect tonight, but what I'm going to do is I'm going to go over the specific questions we're going to have on this quiz. So we're going to start right away, and we're going to start with this first question. On November 1st, 2018, Dual Systems borrows $200,000 to expand operations. Dual Systems signs a 6-month 9% promissory note. Interest is payable at maturity. Dual Systems year-end is December 31st. Now, the question you're going to have to come up with on the exam is to record the payment of the note by Dual Systems at maturity on April 30th, 2019. So it's important for you to specifically look at when the note was taken out and then when the maturity is on the note. So you'll know in respect to recording a promissory note, at the end of the fiscal year, which in the case for your return will be December 31st, you're going to want to have accrued interest from when the note was taken out till December 31st. So in this case, it's only 2 months of interest, and so the interest would be the note amount, $200,000, times the interest rate, 9%. We'll come up with a figure divided by 12, excuse me, and multiply it times the number of months that the note was out prior to the end of the year. At that time, you will record interest expense because we always want to match our expenses with in the current period. So we would show an interest expense, but there would then be a credit to interest payable. So you'll know at maturity, we're going to write off, or we're going to pay off that interest payable. For the recording the payment at maturity, you'll want to calculate how much interest was expensed, or we have accrued, in the second year. So in this particular situation, because the interest or the note matures on April 30th, that's 4 months of interest that on the date of maturity we will show as interest expense. So we would then take the note of $200,000 times the interest rate of 9%, divide it by 12, multiply it times the number of months in that year, which in this case is 4 months. So for the recording of the journal entry at maturity, you're going to see number 3 here. We'll show the note payable of the amount of the note, $200,000. We will debit our interest expense for the interest that is accrued in the year when we're paying the note. We'll debit our interest payable because we're paying off this payable at maturity, and we'll credit our cash for the difference. So in this example, notes payable is a debit of $200,000, interest expense is a debit of $6,000, and interest payable a debit of $3,000 to be a credit for cash of $209,000 to record the payment of the notes payable and interest. That is the one question you are going to have as it relates to this particular problem. Next, Chapter 9 says Aqua Zone issues $1.2 million in bonds. They're $1.2 million 7% bonds on January 1st that mature in 20 years. The market interest rate for bonds of similar risk and maturity is 6%. And it even tells us in this problem the bonds issue for $1,338,689. Interest is paid semi-annually on June 30th and December 31st. Complete the first 3 rows of an amortization schedule. Record the issuance of the bonds and record the interest payments. So one question you may have is, what would be the carrying value on December 31st, 2018? So in this particular situation, they give you what they were issued for, the $1,338,689. We then take, to figure out the cash paid, the face amount times the stated rate. To figure out the interest expense, we're going to take the carrying value times the market rate. So the carrying value in this particular situation is the $1,338,689, and the market rate is 6%. So the carrying value times the market rate gives us the interest expense of $40,161. You either have a premium or a discount. In this case, we have a discount. So we are going to, we have a premium because the stated rate is 7% and the market rate is 6%. So the carrying value is issued greater than what the note amount is. So the difference between the cash paid and the interest gets then subtracted to the carrying value. Then in the next period, remember they get paid every 6 months, so there are 2 periods here. The cash paid will always be the same. It's going to be the face amount of the loan times the stated rate. Face amount is $1.2 million times the stated rate is going to give us the $42,000 in cash. Our interest expense is going to be this carrying value of $1,336,850 times the market rate. The difference between the cash paid and the interest expense gives us our premium on the discount, which we again subtract from the carrying value. So one question could be, what is the carrying value on the bond as of 12/31/2018? So you would need to go through these steps in order to get this answer of $1,334,956. Another question you may have is, what would be the journal entry to record this bond issue? So you would show the cash we received, $1,338,689. We would credit our bond of $1.2 million, and the difference here would be a premium on a bond. It wouldn't be a discount on a bond. It would be a premium on the bond. Another question you may get is, what is the journal entry to record the interest on June 30th? It would be, if you went up to this schedule on June 30th, we paid out cash of $42,000. The interest expense is $40,161, and the premium is $1839. So in this example, we would show the interest expense of $4161, the cash of $42,000, and the difference is the premium on the bond payable. That would be first semi-annual interest payment. So for this problem, you could have several multiple choice, knowing what this carrying value is on a specific date, knowing how to record the bond issue, and how to record a journal entry for the interest payment. Now, here's another one you may have. Suite 16 is the following beginning balances in its stockholders' equity account on January 1st. Preferred stock is $100,000, common stock is $20,000, paid in capital is $380,000, and retained earnings is $450,000. Net income for the year is $65,000, and then they give us various transactions. We would prepare a statement of stockholders' equity, and we would also prepare the stockholders' equity section of the balance sheet. So let's look at the statement of stockholders' equity. It's giving us the beginning balances. the beginning balances would show up here. Preferred stock, 100,000. Common stock would be the 20,000. The additional paid in capital here, excuse me, I'm just trying to get this to work. The additional paid in capital would be the okay, sorry about that, guys. So the additional paid in capital here would be the 380 they gave us, the retained earnings of 450. So we would add all those up to come up with our stockholders' equity. Then it tells us issued $3,000 of it is 3,000 shares of common stock for $22 a share. So we would want to show that transaction. Issued common stock, 3,000 shares. Now it's got $1 par value. So $3,000 at 3,000 shares at $1 par would go into the common stock. The remaining would go into paid in capital for a total of issued common stock here of 66,000 that occurred during the year. Then it tells us issued 5,000 additional shares of preferred stock for $110 per share. So in that particular case, we would show the preferred stock, the 500,000, and the additional paid in capital here of $50. Now, I believe it shows preferred stock 100, common stock 20, paid in capital 380. The following transactions affect during the year. So in this scenario, we know that we would record this preferred stock under the par value would be the amount placed in preferred stock, and the amount over in excess of par value would go into additional paid in capital. Then it moves on to tell us, oh boy, the cash dividends were declared on June 1st. So it paid in capital. So we would need to know, how do we go about figuring out the cash dividends that were paid on June 1st. So the $53,000 of cash dividends paid on June 1st are going to come out of our retained earnings section. The next piece is going to say purchase 2,000 shares of common treasury stock for $18 a share. Well, that's going to be a separate line item of treasury stock, and we're going to show the entire amount as a negative here to treasury stock. And again, we bring forward our total stockholders' equity section here. Then it tells us we purchased 2,000 shares of common treasury stock. Excuse me, we reissued 1,000 shares of treasury stock purchased on August 1st for $20 a share. Now remember, if we bought it for $18 and turned around and reissued it for $20, we are going to show that $18 per share would fall under the treasury stock, and the remaining of that is going to be under paid in capital. It then tells us that our net income is, told us here, $65,000. So we are going to want to make sure we show that as an increase in our retained earnings here for $65,000. At the end of the period, we're going to total all of our columns, and here are our ending balances for the statement of stockholders' equity as of the end of the year. Let me just look back on here and make sure So we went through each of these and we recorded it. So in order to figure out our statement of stockholders' equity, we're going to have to go through all these various pieces of additions and changes to come up with our ending balances. Now these ending balances are what will be on the balance sheet as of December 31st. So one question might be on the balance sheet is, what is the balance of retained earnings on December 31st, 2018? So you would need to go through this process in order to know that retained earnings is $462,000. Or it may say, what is the balance of treasury stock in the treasury stock at the end of the year? Well, because we purchased some and then reissued it, our balance at the end of the year would be a minus $18,000. Or you may have a question, what is the total stockholders' equity section at the end of the December 31st? That would show you the $1,562,000. So you could have, mainly your multiple choice will ask you, what are these ending balances going to be? Next, this chapter 10 requires you to understand various information in the balance sheet. So you see here that it says the preferred stock is at $50 par value. We know that we can calculate how many shares are have been issued, because we can take the amount sitting in preferred stock divided by our par value to come up with the number of shares. We can do the same with common stock. 25,000 divided by $5 par value will give us how many shares are outstanding. Remember, anything above and beyond would go into our additional paid-in capital. So one question may be, how many shares of preferred stock have been issued? Again, we would take the $550,000 sitting there divided by our par value would give us 1,000 shares have been issued. For how many shares of common stock? Same thing. What is our balance? Divided by our par value would give us the number of shares issued, which would be 1,000. Then it says, assuming the preferred shares were issued at par value, at what average price per share were the common stocks issued? So what they're kind of telling us here is, if the preferred shares were issued at par value, there's nothing additional sitting in additional paid-in capital, because they were all par value, so nothing would have been added to additional paid-in capital. So the total paid-in capital for common stock is going to be what the 25,000 plus the 120,000, or 145,000, because this 25 is going to be what is in the par value piece. Our additional paid-in capital is 120. So we know what the par value plus the additional paid-in capital all goes to common stock. That's $145,000. If we divide that by the number of shares that are outstanding that we calculated, then of 5,000 shares here, then we can come up with a $29 per share price. The next requirement asks us if retained earnings at the beginning of the period was $120 million and net income during the year was $30 million, how much was paid in dividends for the year? So we would create an Excel to show our beginning retained earnings. We would show our ending retained earnings. Excuse me. Gosh, I'm just... the 120, net income, they're telling us is 30. Then we want to know what were paid in dividends during the year. Now it told us here that our retained earnings is $140,000. So we know at the end of the year our retained earnings is $140,000. So we can compute what the dividends would be during the year, because our 120 plus our 30 equals 150, minus what would give us 140. Well, that would have to be $10,000 were paid out in dividends. Then the last question, if the treasury stock was reacquired at $20 per share, how many shares were reacquired? So if we look here on this form, we show 20,900 is the balance here in treasury stock. So how many shares were reacquired? Well, in this example, we would say 20,900 divided by the number of the price that we reacquired them for. That would give us the number of shares that were reacquired. So an example of this chapter may be just like we went through here. One particular question could be, assuming this scenario of beginning retained earnings and then net income, you'll know the ending retained earnings from the information provided. You would have to calculate those dividends. Or you may have to calculate how many shares are outstanding given this information. So again, each multiple choice will just have one scenario attached. Okay, here in chapter 11, we've got an income statement and we've got a balance sheet, and it provides us with all the information. Then it will give us some additional information, and from that it'll want us to calculate a statement of cash flows, only using the indirect method. Now please know, my only questions will be, what is the net cash flows from operating activities? Or what is the net cash flows from investing activities? Or what is the net cash flows from financing activities? So you would need to know, based on all this information, what actually shows up in the operating activities, what shows up in investing activities, and then what shows up in financing activities, because if I ask you just what is the net cash flow from financing activities, you would have to know which of the items on the balance sheet would relate to financing. So in this scenario, the payment of dividends, remember, any activities related to stocks and loans equate to financing activities. So this would only be the payment of cash dividends that you would need to know. Or if I asked you, what is the net cash flows from operating? You would need to know, using the indirect method, how we go about showing the various changes related to operating activities. And if you remember, we start with our net income and then we make various adjustments. So the various adjustments as it relates to running the business would be applicable here to come up with our net cash flows. The only thing I'm going to ask you with this problem is, what are the net cash flows from either operating or investing or financing? Chapter 12 really only will deal with ratios. And so you're going to receive information regarding a company, balance sheet, and income statement. And one question may be, what is the receivables turnover ratio for this company? And you would just have to, be able to know how to calculate the receivables turnover, and answer the multiple choice based on just doing a receivables turnover. Or it could be the average collection period, inventory turnover, current ratio, asset test ratio, debt to equity, or times interest earned. So you just want to be able to know how to calculate those ratios in order to complete the questions for Chapter 12. Now, this problem is related to how to calculate interest. Assume on July 1st, Toga Sandwiches issues a $2 million one-year note. Interest is payable at maturity. Determine the amount of interest expense that should be recorded in a year-end adjusting entry under each of these assumptions. You'd only be given one assumption, such as, based on this information, if the interest rate is 8% and the fiscal year end is December 31st, how do we calculate just the year-end journal entry? Remember, if this is a one-year note, and it was issued on July 1st, for 6 months in this scenario, we need to record the interest accrued to come up with the interest we need to show as an interest expense and an interest payable. So we would calculate the note times the interest rate times 6 months out of 12 months, or you can divide it by 12, multiply it times 6 to get 80,000 to be the amount of interest in that scenario. Now in scenario 2, where the interest rate is 9% and the fiscal year end is September, remember, we've got July, August, and September. We only have 3 months of interest here. So we would take our note times the interest rate of 9% divided by 12 times 3 months. The fiscal year end here is September 30th, so we would only be recording interest of $45,000. Again, with scenario 3, we would show the interest rate of 6%, and if the fiscal year end is October, we would only be recording 4 months of interest. January 31st, then there would be 7 months of interest. So just understand how fiscal year ends are how you would record the interest up to that period of time. And that's it. And then you would be debiting an interest expense and interest payable. Even though that loan doesn't get paid until maturity, we still need to determine what that interest expense is in that first year. Then we have Chapter 7 here. I think this is it here. Chapter 7 basically has 2 questions. One relates to the impairment. Gives us the information of book value, estimated cash flows, and fair value. And you have to determine what the impairment is. You've got to know the rules. There could be an impairment if the book value is greater than the estimated cash flows. If that's the case, then you would figure out the impairment from the book value minus the fair value to come up with the impairment loss. So you go through each of these to see where could there be an impairment. Well, the building's book value is at $500, but the cash flows are only $380. So that's an impairment because the cash flows are lower than the book value. Copyright. The book value is 40, the estimated cash flow is 38. There could be a possible impairment. But in the other two scenarios, the cash flows are greater than the book values. So the way we calculate the impairment is we take the book value minus the fair value. Well, with the building, the book value is 500, the fair value is 360. Well, guess what? That would be our impairment loss for the building. In the copyright, the book value is 40, the fair value is 39. The difference there would be our impairment loss there. So both the building and the copyright are impaired, and we calculate the loss by the book value minus the fair value. So the building has a loss of 140, the copyright has a loss of 1,000, so the 140 plus the 1,000 gives us our impairment loss. So you're going to have scenarios similar to this, and you're going to need to know how to calculate the impairment loss. The last question relates to depreciation. You're going to need to know how to calculate depreciation based on the straight line method, based on the double declining method, or activity-based method. Remember, with the straight line method, we take the purchase price of the equipment minus residual value divided by the number of useful years. The double declining method, remember, you don't use the salvage value until at the very end. So when we're dealing with the double declining, you take the price of it, and whatever straight line is, you double it to come up with the amount. No, you may have a question that says, but what is the double declining depreciation amount in the second year? So you would have to figure out the first year. Remember, then you take the 40,000 minus the 20, you come up with a new carrying value, and then you would take that times 2/4, in this example, straight line times 2, to come up with the second year's depreciation expense. Then, lastly, activity-based, it tells us here that the machines are estimated to operate for 10,000 hours, and in the first year they operated for 2,200 hours. So the way we calculate our activity-based is we take the purchase price minus the residual value divided by the number of hours we anticipate this machine to work, and we come up with an amount of depreciation per hour of use. We take that amount times the number of hours it was used to come up with our depreciation expense in this year. So in this particular event, I'll give you a scenario and I'll say, what is the depreciation expense for year 1 using straight line? Or what is the depreciation expense in year 2 using double declining? Or what is the depreciation expense in year 1 using activity-based? So you just want to know those 3 scenarios. And that is really it, guys. So just make sure you know how to calculate those. Go over your notes from all the problems we've worked through, and you really should be fine on this final, as long as you're able to compute everything we've gone over in this study exam. Good luck, guys!